Welcome back, accounting students. This is Mrs. Bloomquist. We are currently working on Chapter 16. Chapter 16 deals with the financial statements and closing entries for a corporation. And we are currently working on Lesson 2, which you'll be happy to know is a nice short little lesson. It is preparing a statement of stockholders' equity. So one of the things that we want to be prepared to really think about is that before we were looking at one particular financial statement, the income statement. And now we're going to be looking at the statement of stockholders' equity. And remember, stockholders are the people that own the shares of ownership in the company. So they are the people that represent ownership shares in the actual company. And we just want to make sure when we're all done, we can put together a statement that represents that information. Okay? Now, one of the things you want to be aware of is that the statement of stockholders' equity, what it is showing you is the changes in corporate ownership for any fiscal period. So whether it's quarterly or annually, it's documenting or it's showing the changes in ownership for a corporation. So as we look at the income statement, and again, I know this is really small little print, so if you want to be looking on page 482, that's a good place that you can actually see something in nice big print, and hopefully your eyes are better than mine. We're looking at the information on the income statement, and then we're looking at the account for capital stock, and then we're looking at our adjusted trial balance. Okay, so we're going to be using these three items in order to go ahead and get good information going forward to prepare the statement of stockholders' equity. So one thing that you want to keep in mind is that every share of stock that's issued by a corporation has an assigned par value. Okay, so the monetary value that's assigned by the corporation is the par value. And corporations can give stock any par value they want to, as long as it is allowed by law in the state where they're incorporated. So different states have different rules about what corporations can and cannot do, but as long as it's allowed by law in the state, they can assign any par value they want to on their stock. All right, so the capital stock section of the statement of stockholders' equity, and remember, again, 3 green products, the name of the report, statement of stockholders' equity, and then for the year ended December 31st. And what you can see then is that we have capital stock with a $10 par value. Okay, so it's listing a $10 par value, and the value of the shares issued on January 1 looks to be $70,000. We issued 5,000 shares of stock during the current year. So the value at the end of the year, when you consider we have all of the 7,500 shares issued, is $75,000. Okay, so this is the statement of stockholders' equity. Again, the par value is just the assigned value, and it doesn't necessarily represent what fair market value of the stock is. Fair market value could be higher or lower than the par value of the stock, and that's an important thing to keep in mind. Par value does not necessarily equal the market value of the stock. All right, so again, I know really small print, so if you want to see this in your book, page 484. When we're looking at the retained earnings section of the statement of stockholders' equity, you can see here's the retained earnings section, and it is down here below the capital stock section. And we're looking at the beginning balance on the account as of January 1st. We're going to go ahead then and enter in the net income after federal taxes have been paid. Then we're going to go ahead and subtract the dividends that we declared on that income. So we know we declared a dividend, and that money is actually going to be moving out. Okay, so we go ahead and subtract the dividends to go ahead and get the total amount of the increase in retained earnings. So it looks like our retained earnings are going up by 64, almost 65,000. And now we can see our ending balance as of December 31st. And we go ahead and add that to the balance based on our par value. Okay, so we're adding the balance of retained earnings to the par value of our stock to get the total stockholder equity number. Once you do that, you want to just keep in mind when you're looking at these reports that retained earnings, so if we go back here, this the increase in retained earnings, that does not necessarily equal cash. Okay, so retained earnings might not be retained earnings, might not be just straight up cash. Okay, earnings that are retained could be in other forms than cash. So we want to keep that in mind. So we'll ask a couple questions and see where we're at. What financial information is going to be on the statement of stockholders' equity? Well, changes in ownership for the fiscal period. That's what we're seeing in the stockholders' equity. Two major sections are going to be capital stock and retained earnings. Where do we find the information to actually prepare that capital stock section? It's going to be in the general ledger account for capital stock. The beginning balance for retained earnings, we're going to find that on our unadjusted trial balance. And then when we actually issue shares of stock, what par value is the corporation going to assign? Anything they want, as long as it's allowed by the state where they're incorporated. Different states, different rules. Where is net income after federal income tax is going to be found? And we just did this in the last chapter. That's going to be on the income statement. From here, what I would really like you to think about is why a company might offer additional shares of stock throughout the year. So why is it that mid-year a corporation might offer additional shares? And think about what happens when companies offer stock. So they make stock available, investors buy that stock, and now you're going to see an increase in cash coming into the business. So what is it that businesses do with the cash that they bring in? They might be looking to expand some of their business operations. They might have a new product or a new location. They might be looking to pay off some of their debts and to reduce their debt load, and might issue stock for that reason. So companies definitely issue stock for different reasons, but you would want to consider, like, why is it that a business would need additional money coming in? What is it they might want to be doing with it? From here, you should go ahead and complete the forms online and do the work together and on your own, and then move on to lesson 3. Good luck, everyone.